I have heard people complaining that poor people do not have to pay taxes because they have less money, and rich people can avoid taxes because they have a lot of money. But the middle class has to suffer by paying hefty amounts in taxes. I have also heard people saying that the more money you make, the more taxes you pay. Yeah, that may be true for salaried employees, but business owners have so many ways to avoid or minimize taxes. In this video, I am going to discuss some strategies used by billionaires to minimize their tax liabilities. And disclaimer, the information shared in this video is only for educational purposes. Consult a CA or professional tax expert before making any decision. If you are a salaried employee, you pay taxes on the entire amount that you earn, and then you can spend and invest the remaining money. But if you own a business, you pay taxes on the money that is left after you pay for the expenses and investments of your business. Also, the tax rate is lower for businesses as compared to individuals. Do you know why taking equity instead of money from your business is a good idea? Because they are taxed differently. If you withdraw money from your own business, you have to pay income tax. But when you take equity, you pay capital gains tax, which is much lower than the income tax. And the best part is you have to pay capital gains tax only when you sell the shares. If you don't sell them, you don't need to pay anything. But stocks do not pay bills, right? We also need real money to spend. And that is exactly why billionaires take loans. A lot of billionaires like Mark Zuckerberg, Elon Musk, Larry Page, often they take a salary of just $1 from their own businesses, from their own companies, when they could have easily taken millions of dollars. But why? Why just $1? To avoid paying a lot of income tax. A lot of billionaires take loans against their assets because borrowed money is not considered income. Hence, it is tax free. And when they pay back the loan later, the interest can be claimed as a deduction in tax. If you invest for the long term, you have to pay 10% of the profits as capital gains tax. But if you die before selling your stocks and your stocks get transferred to your children, your child will have to pay a capital gains tax only on the profit that he or she has earned after inheriting the shares, and not on the profit that you made in your lifetime. This way, the profit you made when you were alive remains untaxed. Another way to reduce tax is to buy things in the name of your business and show it as a business expense. A lot of rich people buy luxury cars, sports cars, houses, etc. in the name of their businesses. As I told you earlier, businesses pay tax on the amount that is left after deducting all the expenses and investments. So, if you buy something in the name of your business and show it as a business expense, it will reduce the profits of your business on paper and consequently reduce tax. If you got to learn something new in this video, make sure you hit the like button and subscribe to the channel. I'll see you in the next video.